Imagine waking up tomorrow and realizing the money system you depend on is shifting beneath your feet. Your paycheck, your savings, your retirement fund, all of it is tied to forces you rarely see and almost never control. The world today holds over $630 trillion in financial assets. That's nearly 5 times the size of the entire global economy. Think about that gap for a moment. It's like your neighbor earning $50,000 a year, but holding debt and obligations worth $250,000. Something doesn't add up. This is where the cracks start to show when the system holds more paper wealth than real economic power. The risk isn't just for governments and big banks, it's for you, your family, your ability to stay ahead on the passive path. We look at these realities without sugarcoating them, because wealth isn't built on hope, it's built on truth and preparation. So what does this imbalance mean for everyday people in North America? It means inflation bites harder than you expect. It means the dollars you save today may buy less tomorrow. And it means blind trust in the system can quietly drain your future. Take the average American household median income hovers around $70,000 a year, yet household debt in many cases pushes beyond 100,000 mortgages, credit cards, student loans, medical. This is the personal version of that global imbalance. You earn one amount but carry obligations far beyond it. When people say the economy is strong because the stock market is up, they often ignore the growing weight of these hidden numbers. The real question isn't whether the charts go higher, it's whether your income and assets can survive when the tide shifts. The lesson is clear: don't assume the system will hold you up forever. Build buffers, invest in streams that don't vanish with the next interest rate hike or market crash. Focus on assets that produce real value, not just numbers on a screen. And here's the thought to carry forward. If the world's largest financial systems can be this bloated, what chance does the average family have if they don't prepare? The next step is to see how the real driver of wealth, demographics, shapes the rise and fall of nations and your own path to financial freedom. Demography is destiny. The story of wealth in decline often begins with simple numbers, births, ages, generations moving through predictable stages of life. A child at age 5 consumes resources without producing income. At age 20, that same person enters the workforce and begins creating value. By 46, they typically spend the most money in their lifetime, buying homes, raising families, paying for education. Driving the bulk of economic demand. When large groups of people move through these stages together, entire economies expand and contract like tides. This is why the baby boom generation created decades of growth in North America. Millions of people all spending heavily at the same time, pushing housing markets up, fueling consumer spending, and driving stock markets to new highs. But the reverse is also true. When a generation ages beyond its spending peak, growth slows, savings increase, demand falls. This is why Japan shifted from economic powerhouse to stagnation after the early 1990s. Their population aged quickly and spending power collapsed. No amount of government stimulus could fully reverse the demographic tide. The United States has so far avoided the same fate because of immigration and a younger population profile. But the trend is clear. Baby boomers are aging, millennials are taking their place as the main economic engine, and Generation Z is not far behind. Look at housing. Baby boomers once drove suburban expansion with family homes. Today, millennials fuel demand for urban apartments and starter houses. Tomorrow, Generation Z may change the picture again, preferring smaller homes, shared living, or entirely new patterns of ownership. Understanding these cycles gives you an edge. If you know when a generation will peak in spending, you can predict which industries will rise or fall. 46 years after a birth surge, expect surging demand for real estate, consumer goods, and family services as that group reaches its prime spending years. This is not abstract theory, it is visible in everyday life. If you see school enrollments climbing in your city, prepare for housing demand to follow. If you see birth rates shrinking, expect long-term pressure on local businesses. The key lesson is simple. People drive economies more than policies or politics. Track the flow of generations, and you can anticipate the future with surprising accuracy. And here is the question to hold on to. If demographics can predict the fate of entire nations, how can you align your financial path to ride those same waves instead of being crushed by them? The answer begins with immigration, the lifeline that can renew a nation's population and reset the economic clock. Immigration is more than a political headline. It is the quiet force that shapes the future of economies. When birth rates decline, nations face a shrinking workforce. Fewer taxpayers, lower consumer demand without new people entering the system. Growth slows and wealth creation stalls. The United States has managed to keep its economic engine running, in large part because of immigration workers, and families from across the world bring energy, labor, and spending power that supports industries from construction to technology. Contrast this with countries like Japan or South Korea. Both face rapidly aging populations, with very limited immigration. The result is slower growth, empty towns, and long-term struggles to maintain living standards. Now look at countries like Canada and Australia. Both actively encourage immigration. Canada brings in hundreds of thousands of skilled workers and families each year. Australia attracts professionals from East and Southeast Asia with strong education and work ethic. This steady inflow balances out their low birth rates and keeps housing markets and consumer demand alive. In North America, immigration has another effect. It creates local booms in specific cities. Tech hubs like Toronto, Vancouver, Austin, and Silicon Valley thrive because talent flows in from around the globe. These workers rent apartments, buy homes, start businesses, and contribute to community life. For you, the investor, this is not an abstract trend. It is a map for opportunity. Follow the flows of people where immigrants cluster, jobs expand. Housing demand rises and businesses grow. To serve new populations, consider real estate in cities with high immigration growth. Rental demand often stays strong even when national markets cool. Consider small businesses in immigrant-heavy neighborhoods, restaurants, services, and retail often thrive because of strong community support. Immigration quality also matters. Nations that attract educated workers from competitive economies often see faster integration and stronger contributions. This is why Australia's intake from Asia has helped it grow steadily despite global downturns. The pattern is clear: when populations shrink, wealth shrinks. When fresh talent arrives, wealth renews. The real question is, will the United States continue to attract and integrate new workers, or will policy shifts slow the inflow and weaken the long-term picture? For anyone building wealth, the lesson is simple: track the people where people go. Money follows, and this leads us directly into another force, reshaping how people work and earn: artificial intelligence and the rise of automation. Artificial intelligence is not a distant idea. It is here, and it is changing the way people work every day. Think of jobs built on repetitive decisions: accounting, legal paperwork, data entry, even parts of medicine. AI can process these tasks faster, cheaper, and with fewer errors. This means a large share of left brain work is at risk. The roles that rely on routine logic, formulas, and predictable outcomes, AI is built to handle them. But not every job faces the same threat. Work that requires hands-on skills is harder to replace: plumbers, electricians, carpenters, mechanics. These roles combine physical action with problem-solving in unpredictable environments. AI cannot crawl under your sink or rewire your house. Creative and entrepreneurial roles also carry protection: design, product creation, business building. These demand vision and originality. The kind of right brain power machines still struggle to match. This shift forces a new mindset. The old idea was simple: go to school, get a degree, find a stable job, stay for decades. That path is fading fast. The new reality is different: lifelong learning, adapting skills, and creating value that machines cannot easily copy. Consider what happened when farming was automated. 50% of workers once labored on farms. Today, less than 2% feed entire nations. Those workers moved into factories. When factories automated, workers shifted again into services and technology. Now services face automation. The next move will be into entrepreneurship and creative industries. People will need to build businesses, invent solutions, and find ways to stand out where machines fall short. Look at Arizona's semiconductor boom. When Taiwan's semiconductor built plants in Phoenix, jobs followed, real estate rose, communities grew. This is the kind of shift tied to technology that investors can spot early. For individuals, the lesson is clear: do not rely on a single career path. Build multiple skills. Seek opportunities where technology creates demand rather than replaces it. And consider entrepreneurship as a serious option. The winners in this new economy will not be those who cling to the past. They will be those who see change, adapt quickly, and build new ways to create value. And this brings us to an uncomfortable truth about building wealth: failure is not the enemy. It is often the price of entry to the next level. Failure is often misunderstood. Most people see it as a signal to stop. In reality, it is a step on the road to success. Every major economic boom has been built on cycles of trial and error. The dot-com bubble of the late 1990s is a perfect example. Thousands of internet startups appeared, most collapsed within a few years. But a few survivors, Amazon, eBay, Google, became giants that reshaped the economy. The same pattern is visible in real estate. Before the 2008 crisis, speculation pushed housing to unsustainable highs. When the market crashed, millions lost homes and jobs. Yet, the reset allowed stronger investors to buy distressed assets at lower prices. Many fortunes were built during the recovery. Failure clears the field. It removes weak ideas and unsustainable businesses. It rewards the ones that can adapt. This is not just theory, it is how capitalism moves forward. Think about entrepreneurship at a personal level. Startups rarely succeed on the first try. Most founders pivot multiple times. Each mistake sharpens the next attempt. What separates winners from losers is not avoiding failure. It is refusing to quit after it happens. For investors, the lesson is important. A crash does not mean the end of opportunity. It often marks the beginning of the next growth cycle. Those who prepare cash reserves, stay patient, and act when prices fall, position themselves for outsized gains. The mindset shift is simple. Do not fear failure. Learn from it, expect it, and use it as a tool. This matters now because new bubbles are forming. Artificial intelligence, cryptocurrency, and high-growth tech stocks all show signs of overheating. History suggests a shakeout is coming, and when it arrives, most players will disappear. But the survivors will define the next era. The real question is, will you be one of the people crushed by the collapse, or one of the few prepared to build wealth from the reset? And that leads directly into the conversation around cryptocurrency and decentralized finance, a space where massive risk and massive opportunity exist side by side. Cryptocurrency is more than digital coins on a screen. It is an attempt to decentralize money itself. For over a century, banking has depended on middlemen, commercial banks, central banks, and financial institutions. They control transactions, hold savings, and set the rules of credit. Crypto challenges that model by allowing peer-to-peer exchange without intermediaries. Bitcoin was the first proof of concept, a system where money moves securely without a bank in the middle. Since then, thousands of projects have emerged exploring payments, lending, asset storage, and entire decentralized financial systems. The scale of disruption is massive. Global financial assets are estimated at more than $630 trillion. If even a fraction shifts into decentralized systems, the change would be historic, but opportunity comes with risk. Crypto markets remain volatile, prices swing wildly, projects collapse overnight, and scams are common. Many investors chase quick gains without understanding the technology or the economics behind it. Still, the potential cannot be ignored. Countries like El Salvador have adopted Bitcoin as legal. Tender major corporations hold crypto on their balance sheets, and decentralized finance platforms now offer services once exclusive to banks. For individuals, the question is not whether crypto will exist. It is how much of it will matter in the long term. Will it replace traditional banks, or will it simply live alongside them as an alternative system? The practical takeaway is caution and balance. Do not bet your future on speculation, but consider small exposure to leading assets as part of a diversified portfolio. Bitcoin, Ethereum, and select projects with proven use cases may survive future shakeouts. Think of it this way. The internet went through a similar phase in the late 1990s. Websites appeared overnight, most disappeared in the crash, but the survivors became Amazon and Google. Crypto may follow the same arc. The coming years will separate empty promises from real value. The winners will not just create wealth for themselves, they will rewrite the rules of money. And this brings us to the bigger picture. The next economic shakeout, why decades of stimulus have only delayed it, and why preparation now may decide who thrives when it arrives. The global economy has been living on borrowed time since 2008. Governments and central banks have poured more than $29 trillion of stimulus into markets. Cheap money propped up stocks, bonds, and real estate, but it masked the weakness underneath. With that level of support, growth should have exploded. Instead, most developed nations have grown at only 2 to 3%, far below the 7 to 10% expected with such stimulus. The truth is simple. Without artificial support, the economy would have looked more like the 1930s. A long, slow shakeout after years of excess. Every boom ends with a reset. The Roaring '20s ended with the Great Depression. The dot-com bubble ended with the 2000 crash. The housing bubble ended with the 2008 crisis. Now technology and debt are building the next cycle. Signs are visible. Stock valuations stretch beyond fundamentals. real estate prices in many cities remain disconnected from local incomes. Crypto and AI stocks surge with speculative energy. History suggests the next stage is a correction, but a crash is not the end of wealth. It is the reset button. The weak are washed out, the strong adapt and rebuild. This is how progress works. For the prepared investor, opportunity will appear in the rubble, undervalued assets. Distressed real estate survivor companies ready to expand fortunes are made not during the boom, but during the recovery. The key is positioning, keep reserves, avoid over-leverage, diversify income streams, and be ready to act when others panic. Do not confuse temporary declines with permanent destruction. The Great Depression crushed many, but those who bought strong companies at the bottom created generational wealth. The 2008 crisis bankrupted households, but it also created the largest real estate buying opportunity in decades. The shakeout ahead will follow the same pattern, pain for the unprepared, possibility for those who plan ahead. The real question is whether you will be ready when the reset arrives, because the path to wealth is not avoiding every downturn. It is using downturns to build stronger foundations, and that brings us to the practical lessons you can apply today. How to build wealth on the passive path in a world shaped by demographics, immigration, technology, crypto, and economic cycle. Wealth on the passive path is built on preparation, not prediction. You cannot control markets, you cannot control demographics, you cannot control when crashes come, but you can control how you position yourself. First, focus on income streams. Relying on a single job or business is dangerous. Jobs can vanish, industries can shrink, but multiple income streams create stability. Consider rental, property, dividend-paying stocks, online businesses, or skill-based side hustles. Each one adds a layer of protection. Second, invest with demographics in mind. Follow the age waves. If millennials are entering prime home buying years, housing demand will rise. If baby boomers are retiring, expect demand for healthcare, travel, and retirement services. Align your investments with where generations are headed, not where they have already been. Third, embrace technology instead of fearing it. AI will replace routine jobs, but it will also open new industries. Learn how to use it. Build businesses around it. Or invest in companies that lead in this space. The winners will not be those who resist change, but those who ride it. Fourth, diversify geographically. If one region faces decline, another may grow. Look at cities with strong immigration inflows, tech investment, or new industries. These places often outpace national averages and create stronger returns. Fifth, stay liquid enough to seize opportunities. When downturns come, assets will sell at discounts. Cash reserves give you the power to buy when others are forced to sell. History shows that the best deals appear when fear is highest. Sixth, remember that entrepreneurship is no longer optional. The safest path is not working for someone else forever. It is building something of your own. A service, a product, an online platform, even a small side business can grow into financial independence over time. The passive path is not about shortcuts. It is about smart positioning, building streams of income, leveraging demographic trends, embracing technology, and preparing for cycles of failure and recovery. The final lesson is simple. Wealth is built by those who adapt, those who see change early, those who prepare instead of hoping. You do not need to be perfect. You need to be ready, so here is the challenge. What action will you take today to create income that survives the next shakeout? Will you start learning a new skill? Will you put money aside for reserves? Will you explore an investment aligned with demographic trends? Your future is not decided by markets or governments. It is decided by the choices you make. Now, if you found value in this video, support the passive path by liking and subscribing. Share your thoughts in the comments and join the conversation, because the best way forward is learning and preparing together.